Thank you very much for joining us this evening. A very warm welcome to Bush House, which is the home to King's Business School. And just to say up front, I'm keen to have your participation in this discussion this evening is very important. You have been selected very carefully to be part of this discussion. I'm Anthony Garner, I'm an Executive Fellow at the Business School. I guess there were four things I really wanted to touch on before asking some of our esteemed guest speakers to start us off on this debate around private equity and the future of private equity in many ways. The first thing was really to talk to you, of course, a little bit about King's Business School and why do we look at private equity, why are we interested in private equity. The second thing was to talk really a little bit about the fact that why, in an odd sort of way, why are we talking about this? What is the subject? What is the question that we are looking to answer when we say, is the golden age of private equity just starting? Then a little bit on, as I say, why you are important in terms of forming some of the views in relation to private equity. And then lastly, the easy bit for me, which is just to talk a little bit about how we're going to go through the evening and talk through not just the panel sessions, but also trying to engage you in a debate which is useful, hopefully, to all of us. So the first thing is about Executive Fellows, which sounds like a wonderful title. And it is, in many ways, a wonderful title. Our Executive Fellow program is really designed, it's taking people from different, to match the streams of both research and education at King's, to try and make sure that the connections are done between what we are doing in the university in terms of research and thought leadership and involvement with those particular industries, and to share that externally, but also vice versa, to be able to bring in from those particular streams of excellence that we are focusing on, get the opinions from people out in the wider world and bring those in. And that is actually what this is all about. So all of you in different ways have connectivity to the private equity community, even if you don't know it. And one of the things that is always surprising is the fact that private equity is something which touches all of us. The thing that I also do, apart from being an Executive Fellow, is I teach private equity here. So it is something which we have now been doing for 4 years. The last cohort, which was the one that finished just this summer, so they'd be graduating now, totaled just over 500 students learning private equity. And that's sort of interesting. It's interesting from our perspective because what it says to us is that there is a level of interest in this subject which is probably way beyond what the media would perhaps want us to know. And bear in mind that the people who are on this, this module, are people who are interested in being private equity folk, maybe because they think of some of the big private equity businesses that are out there and the individuals who are there. And Johannes and others on the team might be able to speak to that a little bit. But they're interested in private equity, they're interested in banking, they're consultants, or they want to be consultants, but they want to understand what private equity is. And many of them, thankfully, are interested in being entrepreneurs. I think that's another theme that we focus on quite a lot at the business school, is about entrepreneurship. And therefore, understanding how businesses get financed in their various different stages is really important to them. So, most of you, I find it very rewarding, honestly, to be able to teach this class. And another sort of interesting fact, apart from the fact that this is probably the largest dedicated, at least for the undergraduate level, but the largest dedicated class on private equity possibly in the country. I say that without having checked these facts, and you don't need to check them either. But anyway, it's a good story, but probably right if there are 500 odd doing this. So, what is interesting about private equity, and one of the things that at least we try to convey to our students, is that this is not a single discipline. This is a subject matter which covers business. It covers, how does a business work? What's the context to a business? What's the strategy? Importantly, management. And we have in the group here this evening managers from portfolio businesses of private equity who may share some of their perspectives later on and ask some tricky questions. There are at least 2 of you here that I know do ask tricky questions, so we'll see what happens later on. But it is lots and lots of different things, so not one single thing. It's combining a lot of different elements, disciplines. It's not accounting just, it's not just modelling, it's lots of different things. So it's interesting. So that's sort of, I guess, the second thing I wanted to say. In terms of what people say about it, and this is really why do we have this subject. So if you Google, that's not how the university normally does its research, but I've done this, okay, is if you Google Golden Age private equity, you have loads of articles, right? Mostly when you put over in it, okay? Golden Age private equity over, finished, kaput, okay? If you look at it in a little bit more detail, you realize that, of course, this is complete nonsense, okay? And there is, I have to say, and I'm afraid I have to quote something, this is where I get my glasses up because I can't quite read this particular quote, but it's from the Times this morning, just to show how quick we are to respond to things in the media. So from Sir Malcolm Walker this morning, who is the founder of Iceland, big frozen food business, his comment is, amongst other things, he was complaining about the potholes in the UK and other things, but just after the potholes, he got to private equity, and his comments were, London's stock market valuations are languishing, while private equity players are buying up far too many great British companies, selling their assets, extracting cash, and piling them up with debt that they won't be able to service in the long run, leading to a string of business failures. Fortunately, none of you would actually say this guy is saying a very sensible thing, because it's a little bit more complicated than this. But it is a perception, in a way, that I think, certainly I feel, education, broader understanding of private markets, not just private equity, needs to try and respond to. So the subject that we have today is the golden age of private equity just starting, is really because I think that private equity does many, many things, again, that we'll come to talk about in terms of adding value to a business, which are not readily accepted or readily picked up by the media. And some of you from the media hopefully will accept that and perhaps question us on that in a way. Why you guys are very important is because what we have in the audience today is a mix of different people who come from the investment world, from, as I said earlier, some managers from portfolio companies, bankers, lawyers working in private equity, obviously the media here, family offices who might be investing in private equity as well. And so therefore we have, and there are others, but basically we have different views, also from our student community, by the way, who hopefully have either attended my module at some point in time or just passionate about the subject anyway. We have people here to be able to generate the type of discussion which I hope that we will have and will add value to us. Just therefore, just to talk a little bit about the running order here. So first of all, obviously you've got me just giving a little bit of an introduction. I'm going to ask Johannes, so Johannes who's from KKR, Chairman of the European Business, Middle East and Africa, given a really difficult job because he doesn't really know. I also said, could you please talk about the subject matter and see what you want to say? So that's very good because he can do whatever he wants at this point, but I hope that you will get some, I'm sure you'll get some pearls of wisdom in relation to that. I've asked Andrew McCaffrey from Fidelity to then talk a little bit more about private markets. In particular, this is about saying, how does that fit in with the wider financial world? And I'll come to something else in a second on that. Simon Nixon he doesn't say it here, but he is a former banker as well as being Wall Street Journal and The Times. And lastly, but certainly not least, Joanne Sonin, who can add an extra perspective, which I know some of you have already mentioned to me this afternoon, which is talking about, can private equity provide societal good? Can it contribute to doing certain things which, let's face it, again, if you read the papers today, we have a government, or in fact both sides of either the future government or the current government, saying there's no money, basically. So how are we going to fund all these wonderful things that we have to have done, particularly in relation to climate change or just changing things which are fundamental? And my argument, and I suspect that we'll have this as well from our panel today, is that actually a lot of these things are possible and do happen because private equity does invest in things that actually are good. Again, somewhat against the thoughts of the asset stripping that Malcolm Walker was talking about earlier. Just then, and then after that, after we'll have a panel debate, we'll ask you please to engage actively in terms of questions that you may have. Doesn't matter what they are. If they're about private equity, that is good. But you have obviously a few experts hopefully here to answer them coherently. And then lastly, we'll just wrap up, and hopefully you will join us. Robin Klinger-Vidra will be talking just for a few minutes with a couple of the themes that we will have been talking about during our session here. And then we'll hopefully be able to have a glass of something cold and refreshing after that and chat between us all. But just one last thing to show to you, because I think it's sort of important to understand this is an important asset class. And what I wanted to show here was the top yellow bit is the switch over to private markets. And if you look at the asset classes generally, everyone talks about the 60-40 split. We've been talking about that for years and years. And in recent years, that has been less coherent in terms of its strategy for investment management than it might have been in the past. I suspect Andrew will pick up on this a little bit. But if you look at it, a third, roughly, of what is invested in by institutions is the private markets, of which private equity is a big component, but very similar characteristics across all of them. So this is not something which is irrelevant. And again, just coming back to why King's is focusing on this, is because it is a huge asset class and honestly deserves a little bit more time in terms of academic rigor and debate and education. So I'm delighted, therefore, to not put that there, but I will just leave that there for the moment, to invite Johannes Huth up to set us going and just talk in response, as I said, no extra coaching, just simply to talk a little bit about the golden age of private equity. Thank you.
Okay, good evening. First I have to admit this is a bit of an away game for me. I'm part of the council of the LSE and head their audit committee, so I know that I'm on enemy territory, but I'll try to behave. So when I thought about this topic, I thought it's maybe good to go back a little bit and look at the development of the industry. And I'd really prefer to talk about private markets and not just private equity, because it's a broader area. But when the industry started really in the US in the sort of early 70s, the industry, it was an industry where it was very easy. We had a golden time then because there was very little competition. Not many people were doing what the pioneers in the private equity industry were doing, and they generated value generally by being able to buy assets quite cheaply and then sell them a little bit later for better prices. Of course, as markets are somewhat efficient, that period came to an end as more people cottoned on to that. But we then had a period where it was easy in the private equity industry to make money by using leverage. And sort of the heydays of the early high yield markets. And returns were really generated by leveraging businesses, and you were able to do that better than your competitors, so that you had a competitive advantage through leverage. When KKR bought Safeway, we bought it for $8.2 billion with $120 million of equity. That's leverage. Okay? Again, that market started to be arbitraged away, and that competitive advantage went. We then came into a period where effectively we were able to create value by focusing on more operational aspects. So again, most of the private equity firms started to focus on how do we actually improve businesses when we own it and try to create value in that fashion. And that's a period that went on for quite a while. And by the way, each of these things are still relevant today. But if you did that better than the competition, you were able to generate incremental value and therefore outperform. So again, we had a period where having a sort of operational focus allowed you to create a better returns than the competition. And then we entered the period where we'd been in for, let's say, maybe 10 years or even a bit more, where we've had an environment of falling interest rates. And that sort of wind in the back drove the whole industry. So I think we actually had many different periods which were good for the industry and which allowed the industry to grow. And so I think the golden age probably started in the 70s and kept on going through different stages. to get us where we are today. So what then do we look at when we think about the future? And I think there's a number of things where I think the industry will continue to grow. And the first one is the one that you mentioned, or that Malcolm Walker mentioned with the potholes. And that is that when we look at the energy transition and climate transition, it's a project that the EU has put aside in terms of the Green Deal, roughly 500 billion euros. But that's by far not enough to fund the projects. So where's the capital going to come from? It's not going to come from governments. So it has to come from the private sector. And that's really where the industry can play a significant role in helping that transition to take place. And I think that's something that we as an industry are in a lot of discussions with the various departments at the EU about, and that's where we're talking to governments to see how can we facilitate that this capital can actually connect with the needs that some of the governments perceive and that we perceive there, to facilitate a better approach to climate. That's definitely one of the areas of growth. And where is that money going to come from? And that's why I think there is another significant area of growth. And that is, when you look at where the capital of the industry comes from today, 90% plus comes from institutions. Almost nothing comes from individuals. When you look at the global asset industry as a whole, roughly 100 trillion, and this is numbers coming from Goldman Sachs or some of the others that look at asset allocation, roughly 100 trillion is institutional, but 170 trillion is individuals' money. So it's much bigger. Out of the institutional money today to alternative assets, you have allocated somewhere between 13 and 15%, depending on who you look at. Out of the private capital today, less than 0.5% is allocated to alternative assets. So there's a significant opportunity to put more private capital into alternative assets. And by the way, it's something that the regulator is encouraging. And the regulator is encouraging it because he thinks that there should be more democratized access to private capital than that's the case today. They don't think it's fair that only very rich people can invest in this asset class and not everybody else. And so I think that it's going to take some time, but I do think that there's going to be much more products that will be aimed at the individual investor with the right protections and so on attached, and that there is a significant opportunity in terms of growing capital there. So I think there's a lot of things that the industry can go through. If we think through some of the more recent areas where our industry has grown, private debt is clearly a market that has grown absolutely significantly, and we think that's going to grow further. Effectively, the industry has taken over some of the functions that the banking industry has left behind, and so I think again there we will see growth. So I'm quite positive in terms of the outlook. I don't know if it's going to be the golden age, because I do think we've seen very different phases of growth, and I think that's going to be a further phase of growth that we're going to see. So that's sort of my opening remarks, and with that, I'm going to hand over to Andrew.
Thank you very much, Johannes. And I'm going to build on a couple of points that Johannes has just made as well, by giving a little bit of insight into where we're seeing allocations coming from into the private markets, but also some of the drivers for that, which will sustain the nature of basically new investors and some of that more individual investor. And within that category, which I think is very relevant when we look around the UK and look forward for how do you move capital that has been historically long-term investment from things like pension funds that would define benefit into the defined contribution world, and how that's incorporated to create that capital that then can go into the long term. So if I just take you to this slide that just builds on what you heard from Anthony as well, that the degree to which we've seen this sort of growth of managed private markets. And I think it's important, I'm sure we'll talk about it to follow on, but sometimes it's forgotten, but the capital market formation is that the companies staying in private hands is ever increasing in terms of longevity of staying in private hands, of where the value is created. But you are seeing that this allocation profile from different into the different areas within private markets. And obviously, as you look forward, these are using one set of forecasts from Buchan, who are very well known in terms of their insights and the degree of data that they capture from institutional investors and other investors, is that continued profile of managed assets. But it's this side of looking and builds on what Johannes was saying, that if you look at the ultra high net worth individuals, that significant increase in allocation, but still relatively high. What we don't have on here is back to that point of defined contribution, retail, mass affluent, which basically is down at, Johannes said, most probably, if you were to look at individual categories, maybe somewhere between 0.5% to 1%. And so, there's another significant bar that can be added on here. But just that you look at the existing investors, that the allocation profile is still increasing. And part of the reason that's driving that is what you can achieve by allocating to these different types of private market investments. Here, this is not a complete range by any means, but just giving a sense of the types of categories you think when you're allocating into real estate, infrastructure, private credit, and private equity. But what are you looking for? And I think these are very important when we think about, as people look forward, and especially when you think about those who have invested significantly into the area already, that what they will be looking to try and achieve from this, because it's not just one characteristic. It's not just an enhanced return and taking an illiquidity premium. It's the ability to capture different type of characteristics through time. But also, I would venture that as we look at public and private, the reality as we move forward is that we'll be looking at them much more closely together, because we're looking at what is the opportunity we're trying to capture. How do you best capture that? Is it in the type of underlying investment, maybe private or public? And the degree to which you can incorporate is going to be elements of how you can absorb that degree of illiquidity into a portfolio. And I think just as an interesting one, that look back to the global financial crisis. We've seen a radical change in the allocation of private markets since then. And yet if you think back to that period, it was all about illiquidity, the challenges of accessing assets, the decline you saw in asset values. But what happened is that many institutional investors, whether it be large pension funds or other forms of sovereign wealth and the like, is that what they saw was their actual cash need, when they calculated it, was nowhere near as high as they feared. And it actually acted as a propulsion for them to allocate more into private markets. And that's why you've seen those numbers continue to increase through time, this understanding of how they can incorporate them effectively as well. This is something that certainly can create argument. It does within our organisation amongst the investors, is that looking at this, in effect, risk-adjusted returns. Now, I think you have to be slightly careful because of the nature of how an NAV is calculated and the time profile for that, which I think will, as Johannes was saying about the introduction of things like long-term asset fund in the UK, the European long-term investment fund in Europe, to allow access to some of the private markets instruments. You'll see changes to a degree in terms of calculation periods and the nature of how we look at these markets. But the characteristics when you look back through time is that they've been very attractive in terms of what they add to a portfolio. Diversification terms, opportunity for enhanced return, to be able to bring volatility down if you can absorb that degree of liquidity profile. And this really just what it means in practice, and why you've seen strategic asset allocation increasing its use of private markets in the incorporation, and now starting to come into, I think, across all investor groups, is the opportunity to improve that efficient frontier and what that means in terms of overall impact for investing. But I think one of the points that Johannes made, which is really important, of this, use it in the access of just rich people. I think there's a more important point, is that if you are investing for long term, which pension funds are, and your defined contribution pension scheme is something you cannot access for many years, especially many people sitting here will be having them for 30 years plus, 40 years. you want to be able to tap into the types of investments that give you enhanced return that match that longevity of horizon. If you are not allowed to, then you are not getting the opportunity to create the best possible pension pot, which is a very important issue for any government to be able to create, to allow and remove the burden from those governments and from their fiscal position over time. So these are very much interconnected in terms of thinking of how the stimulus for not just the investment aspect, but that opportunity to be able to align to your investment horizon and the opportunity set that comes with that. So with that, I'm going to pass back to Anthony.
Well, thank you first of all to Johannes and to Andrew for giving those insights. I hope you can see that it already starts us on the path to talk about some of the subjects that at least I've heard a few times already this evening about sustainability and climate change. So probably the first thing to do is perhaps pick on that one so that we can start the discussion going. We're fortunate to have Joanne here to help us with that. But I think one of the things that is interesting from what Johannes said is, of course, there is a need for private money to help to do the things which need to be done because it's not there in the public domain. The next question that the people who are somewhat cynical will say, well, but how much do you want in return for that? So in other words, can you actually spend the money in the right way and get the returns for the investors that have previously been looking at certain returns? Does it all work? So Joanne, giving you the most impossible task now to answer that question, perhaps you could just give us some thoughts on, can you reconcile doing good things, framework in terms of infrastructure, as well as doing other good things, but still align yourself with excellent corporate purpose and excellent ESG and excellent sustainability?
Sure. Happy to tackle it first. I don't even think the question is really whether you're doing good. I think it's whether you're investing well. And I think regulation and capital are the two sort of pillars that are important to getting funding of companies that are transitional and transitional industries. We work a lot with private equity, and we look at corporate sustainability or ESG, call it what you will, depending on what side of the pond. ESG can be a loaded term, so we tend to defer to corporate sustainability. When we work with private equity clients, we say, look at it as another bucket of data. Look at this data, do your due diligence, figure out how you're pricing this risk. Look at it like everything else. By ignoring sustainability and ignoring ESG, you're leaving a blind spot in your investment process. This should not be a separate pillar on the side. This should be integral. When you're looking at a target, do your ESG due diligence as part of that. I had a big, I used to be in traditional finance. I used to be a banker as well for my sins. So I have a lot of relationships there. I was talking to a real estate investor, a big investor with billions of, significant capital. And the question was, this G and ESG, how is that different than, governance? And I said, it's not, it's the same. But that's such a sophisticated real estate investor didn't even put the thought in to realize that it's actually something that you should already be doing. You should be looking at this bucket of data, figuring out what makes sense to you. What, transitional industries are not just about doing good and doing the right thing. It's about a transitional economy. It's about getting those returns, because if not, you'll be left behind. And ESG and sustainability being part of that. When you're looking at targets, when you have portfolio companies, what are your portcos doing? What should they be doing on ESG and sustainability? But doing it in a way by identifying what's material. Ignore the things that aren't material. Focus on the material issues. And then how can you improve performance? How can you improve operations? How can you satisfy your various stakeholders? How can you comply and get ahead of the regulatory requirements? How can you identify competitive advantages for get the best employees? Satisfy your customers. If your customers, your clients have regulatory requirements, why not be in a position to help them reach that by giving them the information they need? So there's a lot that can be done to progress and to do good by actually just being a good investor and treating ESG and sustainability as an integral part of an overall process. And then, of course, when you get to exit and trying to think of what your buyer might want, public or private, how can you untrap and crystallize some of that value for yourself, even though you've got a time horizon that might not realize it, by identifying it and positioning your portco to exit? Are you not then allowing yourself to keep some of the value that the buyer, who might be more sophisticated on ESG and sustainability, will be looking into? So I think private equity has a lot to think about and serious roles to play in helping this, and it's along with important regulation that will keep the guardrails there. So that's.
So I had this discussion, again, some of you, if you'd been on my module, you would have perhaps had an interview with the head of ESG at one of the Swiss private equity firms. And the debate there was really about whether or not, again, very similar attitude displayed there, but one of the questions still I was going and being somewhat cynical, saying, does private equity do this for the right reasons? Okay, so number one is about returns, but do you prejudice those returns if you're doing good? And I believe you don't, and particularly when you go to the exit point, which is unless you have got a business that's fit for purpose in the future, you won't be able to sell the business, as Johannes was talking about earlier. You have to buy the business, create the value, and then find somebody who will buy it and value it more highly than you do. Simon, from your perspective, looking at it perhaps from a sort of helicopter view of the changes over the years and the greater focus on sustainability and investing in the right way, have you any thoughts on that?
Yes, well, I suppose the industry's changed a lot since I first encountered it. I think Johannes probably can't even remember, but I first came to see Johannes about 20 years ago when Keiko was a much smaller outfit, and so was private equity. I think the bit of the ESG that I think that interests me most is the G bit, actually, in a way. I think that's when Johannes was talking about these golden ages of private equity and the history of private equity, I think that one can't leave out governance as an important driver of the creation of the industry and its evolution. The other day I was researching something else, but I came across a very interesting essay by Peter Drucker, written in 1991, about the role of pension funds in the stock market, and it was at the beginning of the shareholder value revolution. And he was making the point that the growth of the pension industry in America had revolutionized and transformed the public markets in America, because in the space of 20, 30 years, from the 1950s, the occupational pension schemes in America became the primary owners of the stock markets in America, and suddenly found themselves controlling these businesses that in the past had been maybe the owners had been running them, and having to take responsibility for the ownership of the corporate sector. And it and it led to this transformation in the way that the public companies were run, and so they focus on shareholder value and getting rid of Jack Welch, and you won't remember Jack Welch and GE in America, but famously the boards were companies were almost sort of uncontrollable. They could set their own targets, set their own metrics, and shareholders got a raw return. So you had this sort of shareholder value revolution. But with that, over the years, you've had this sort of huge increase in governance in the public markets. And I think that you can't strip away the growth of the private equity markets from what's happened in governance in the public markets, where a lot of the reasons why people have moved to that is to get away from some of the governance standards or the governance issues in the public markets, and which comes back to Sir Malcolm Walker's comments that you were quoting earlier about the sort of this idea that all the good companies have been taken away from the public markets. And so I think governance seems to be a huge issue, and from a journalistic perspective, I mean, the key characteristic of the private equity industry is the word private, that it's private. So, from the outside, it's very hard to tell really very much about what's going on in terms of governance or ESG, or it's not transparent, so it's very hard to tell. Hence, you have so much there's some, it has a sort of, the industry has a bad image in the media. But I think that, as I say, I think governance has been one can't strip away, say, the issues of governance, both from a positive point of view in the sense that it enables the private equity industry to do things that you can't do in the public markets, but also from a more negative point of view, it's simply, that it's enabled a group of insiders to escape the kind of scrutiny in the public markets that has enabled people to create enormous amounts of wealth. But who for? That is also a big open question. So anyway, I'll just leave that point there.
I think actually you mentioned the point about the private equity markets are private, so therefore you don't know what's going on. I had this exact discussion with a journalist who explained to me that the problem with private equity was that it was private, and they didn't really know what was going on. I'm thinking, well, you don't know what's going on in another private business, so why is it any different? But probably an aside here. What I think is perhaps better to focus on is the different ways in which private equity adds value to businesses, which is not just about the financial structure. Again, this goes back to the simplistic view that it's all about leverage. And you're right, Johannes, the Safeway deal was, I think, a miraculous deal in terms of leverage, in terms of how that one was done. But actually, operational improvements, and Joanne, you were talking about it as part of the story as well, is a core part of an investment case. And Johannes, I wonder whether or not you would perhaps talk about the role of management teams in delivering that operational excellence, and indeed, as the industry has evolved, about the people who KKR and others will put in to assist with that particular proposition in terms of optimizing the businesses, making them better, growing those businesses. So instead of it being although it may be structured as a buyout, it is a growth buyout because you're going to grow the business operationally to drive the value through making it a better business.
So maybe just Simon asked who made the money? Well, the money went to the investors in private equity, which is largely pension funds, teachers, policemen, firemen that we work for. That's who the money went to, and they quite frankly got more money in this way than they would have gotten if they would have invested in the public markets. So I think that's why they've invested in it. I don't think that we can argue about that. Now, as to the and you touched on that on the model of governance, I just believe that the governance model that we have as private equity is a better governance model. Why? Because there's a clear alignment of interest, you went back to Drucker, you go back to Coase, who got a Nobel Prize for it, and wrote to the CEO of the firm in, I think, 1959. Which basically makes a point that if you align the interests of a management team and the interests of an owner, you get better results, and that's what our industry does. And so I don't think and I think when you have a large disparate group of owners who may have different interests, then you are in the public markets and probably don't have that alignment that you do have in the private markets, and I think that's largely responsible for the incremental results. And of course, in the process, management can make a lot of money, and that's why they join. But I would say the oversight of those firms is much better than it can be in the public markets, because our executives sit in the boards of these firms. They work with these firms on a weekly basis. They therefore probably have a better knowledge than somebody who goes to a quarterly board meeting. And if the management doesn't perform, they get removed very quickly. So which again in a public forum is more difficult. So I mean those would be just a few remarks maybe to get a discussion going.
Yeah. Andrew, do you want to add to that particular discussion?
So I was going to go back to what Joanne was saying more broadly, and the fact that thinking back to the investors and the influence that they have, and the degree that you're seeing now that they are expecting certain outcomes from the considerations around ESG, and especially as we move into the transition economy and elements of sustainability that are linked to that in many different sectors, that the investors are expecting to have transparency, to have greater understanding, to have the alignment towards the outcomes. And I think one of the things that's changing is that rather than having a preset set of criteria that actually you don't know what the outcome might be, is that they're far more focused on is this producing things that actually align to their mission statements, their expectations, that what they have for their trustee board agreements and for the mandate. And that is driving all forms of private markets to actually have to respond, and also to improve the level of in some ways, elements that have already existed but are just going to be drawn out more clearly, of how many of the investments actually are creating societal work. They are improving some of the elements of how economies can operate. And I think this is going to be very important looking forward, because if you think about just where we are today in the UK, that as COVID struck, you had something that the UK government put a lot of effort into, productive finance, which is all about drawing long-term capital into the economy. As we go into obviously this election now, that both shadow and current government looking at the ways in which the policy can support the private capital being brought into the country as well as redeployed that's already here to take on that long-term investment, with a view to basically a lot of it is sustainable and transition economy benefits that will accrue. So in some ways that the policy framework has to be also aligned and supportive of what capital to be put to work, and for private capital to come in, it has to have the opportunity for clarity of return, but also that it can generate the sort of outcomes that investors will expect from that allocating the capital. So I think that some of the virtuous elements are not being drawn out, and yet they actually exist and will accelerate as we look forward.
So perhaps just to sort of also talk about the structure of the private equity world, and think about, again, it sounds as though I'm obsessed with the quote that I gave you earlier about private equity coming in and buying public companies, but of course that is what has been happening quite a lot. So a number of public companies have been bought by private equity firms. And it drives you to think not just simplistically about how can that happen. It drives many different elements of it. The first one that I just wanted to touch on was, is the private equity community actually creating a completely parallel financial structure for a business to evolve? Because as one of my friends said to me not that long ago, it's sort of strange that everybody in the past used to want to be the chief executive of a public company. And that was good news in those days. Yet now, that may not be the case. And what I think, Johannes, you at KKR have in particular, but many other firms, is actually a number of different funds which could take a business from a relatively early stage in the life cycle through to pretty mature stage. And so they don't necessarily ever have to touch the public markets. And then from your perspective, Andrew, of course, then you're sort of thinking, well, is that good or bad? Well, I presume in a long-term basis, that's not a bad thing, because you're mirroring different types of investment with different profiles to them, with different types of returns attached to them. Johannes, do you want to just pick up on some of those elements, which is, I guess, the opportunity that just didn't really exist before to fund a business through a life cycle, particularly given that at the moment life cycles are much shorter than perhaps they would have been in the past?
Yeah, I'm not sure. I think, it's hard for us to sell to ourselves to some degree. Okay, if that makes sense. So, or at least do that without any third-party intervention, because then, both sides of investors are asking at what price has this been transferred, and what are you doing? So, I do think whilst we have different pools of capital from early stage to growth to more mature, it doesn't really happen that often that those pools sell to each other. That's for those governance type reasons.
Joanne, do you want to add to that?
No, I was going to make the comment about it used to be the goal to be a CEO of a listed company, and that begs the question whether all those companies should have been public. So companies that are back in the private sphere, many of them maybe should never have been public in the first place, because often companies went public for vanity projects for CEOs or for the aspirations of being, often we think of markets, we think of the big names, those big companies, but it's all the companies underneath that often are underperforming, are not operating, are not realizing sort of efficiencies on either traditional metrics or ESG or sustainability that will perform, should never have been in the public markets in the first place, or at least will be better off in the private market to perform better and unleash some of that value.
Andrew, did you want to add to that?
I suppose the part that has become very obvious to us is that from the whole structure, as I said, back to capital markets, is that if we want to be able to participate into different parts of economic sectors and to different opportunities, we have to view private and public as ways to be able to access them, not in the you can only do public, you can only do private. And that, I think, is something that has changed quite substantially over the course of recent years, as both knowledge and allocations have increased, but also as we've seen some of those underlying trends that, as you said, that some cycles are shorter. Well, to be able to capture those, you have to be able to participate in the private equity or in the venture capital world as well. And that, I think, has just driven that, for the most sophisticated investors, then they've already made that move. Many others are now looking at what are the opportunities set again, coming back to, and I think going back to the transition economy, it's a very grand term, but the reality is when you look at some of the things, the digitization, many of the opportunities there will not be realized if you are not there early or in that development growth stage, which are likely to be still very private in terms of the nature of that development. And so it's just again that the mindset of the investor has changed, not just the provider, the investor, and that I think is still changing quite rapidly and has a lot further to go in terms of how they incorporate but understand the use of private and public. And so the sense again comes back to, if you understand what liquidity you need, then you can be far more agnostic about how you access the opportunity. The fact you can incorporate things that would be slightly left outside of your opportunity set, you can bring in, and that is very attractive if you want to generate long-term returns. You want to tap into some of the ideas that will be in a private space that are linked to sustainable outcomes in a much more visible way.
So just conscious that we started a little bit late and I'm trying to get us to end sort of at the right sort of time. Perhaps just we can continue doing with the panel discussion, but just to start the discussion with any of you who would like to comment on anything that has already been said or ask something completely different to anything that we've been talking about, please feel free to participate. There's always a very quiet moment at this point because nobody wants to say anything.
Behind you.
Sorry. Yeah, please.
It's Winston. First of all, I'd love to just say a warm hello to everyone, since I didn't realise when I came here I'd known most of the people on the panel, both Anthony and Simon from Fleming days, and of course with Johannes and Andrew through but I haven't met Joanne, but one of my questions would be on the I suppose you can broaden it to the impact investing space. I made a couple of very large commitments whilst I was at one of my institutions into some of the largest impact funds that came about, and they spent a lot of time establishing a measurement system, not just one that was measurable, because you can measure 1,000 watt in a few million school desks, and so, but one that was measurable but also calibratable across. And that seemed a very important one. And then number two, whether that was something that could be taken forward by the other investing platforms, so that it became a standard. And without that, I think many would say it's great we're sort of doing good, but who knows what good, and I'd just be interested to see what your thoughts were on that.
Just because, sorry, before Joanne will answer that, but just to, because I'm not sure, Winston, when what we call the whole question, but just for anyone else in here, is really the summarized version of the question, I think, is just impact investment, great. How do we measure it? Because if we can't measure it, then sort of so what, I think, is really where we are. Joanne.
Yeah, no, it's absolutely correct, and that's sort of my day job. We spend a lot of time working with asset managers, impact investors, but also those who aren't impact. You know, Article 9. It depends on the type of investment. Setting up the systems that, because the standards are so different, and because there's a lack of standardization, it's really a question of how much that asset manager actually wants to dedicate to it. If it's a proper impact fund and it's high on their priority list, setting up systems that actually allow them to collect the data, measure it, and then also report it, and calibrate it, of course, but then report it and share that in a way that is systematically consistent so that the investor can actually get an understanding of what they're doing. But even for non-impact investors, just a regular investor that are trying to communicate to the investors, to the stakeholders, what they're doing in order to capture that, the importance of having a system in place that will allow you to process that data and communicate what you're doing is incredibly important. And without it, it's you fall on all sorts of sort of greenwashing and impact washing and all sorts of. But the investor market, the institutional investors are becoming increasingly sophisticated in their understanding. So, DDQs, ESG DDQs that you might give to a manager have dramatically improved. There's still a long way to go. We work on those as well, but the sophistication is increasing, and there will be more standardization with time. But it's it's a big issue, and it requires genuine dedication to the process and to the desired result. But if you can get there, it will reward you with being able to attract the type of capital that's looking for that sort of transparency around what you're doing. And the firms that aren't going to be able to give that transparency will not win in the battle for capital. I don't think.
Andrew, I'm not sure from a sort of investor perspective you wanted to add something to that.
No, I mean, I think Winston touched on it with the calibration element, and really, I suppose the way we've looked at it, we have a real estate impact strategy. So it's something we spent a lot of time before launching it, was the KPIs that are real, that link to the outcomes that you're trying to achieve, and then how, again, the data that you're capturing allows you to be able to not only keep yourself honest, but be able to share that and to understand that pathway, and again to I think it's an important point, is the calibration, to be able to understand how you compare as well over time, and given what the strategy is trying to achieve, because you will not have all strategies trying to achieve the same thing, and the focus of where their activity are. And so I think that it is evolving. I don't think we're anywhere near the point where you could say that each investor thinks and looks in the same way as well, because as Joan's saying, that you just don't have the standardization yet. It's still early days, but I think that you will see that develop, because more capital is moving this way, and it will be expecting of this degree of being able to understand, if it allocates to a KKR, a Fidelity, or anyone else, that how they can view that their investments are generating, as I said, the pathway to the outcomes that they expect and need.
Martin, can we just get just here? Sorry. Thanks, Des.
Thank you. Thanks, Anthony. So, question from me, actually, and it's aimed at the whole panel, but in particular maybe Johannes and Andrew. Firstly, a point, golden age of private equity. I think if you can't look back with fondness and look forward with excitement, you've probably been doing something wrong, or you're planning to do something wrong. So I think there's more than one golden age, firstly, but not wishing to steal your thunder. My question is as follows, and it's to the point about ESG and sustainability. When I think about the requirements of a private equity investor, what I believe they typically look for, and I'm on the receiving end of investment, not on the giving end of investment, is a backall management team, strong organic growth, diversification, a proven track record at M&A, execution and integration, strong ARR, ultimately a 3 times return on money for the investor, at least over time. My question really is, where does ESG and sustainability fit into that list of priorities? And more relevant to me, actually, does it vary across small cap, mid cap and large cap PE? because I don't think it's a one-size-fits-all, but I'm interested in whether or not the appetite varies depending on whether you're talking to a sovereign or a BGF, or you're talking to a KKR or a Bain or whoever. Is there a variance in terms of importance on that list of priorities?
Thanks, Martin. I was going to just say, by the way, if anyone is asking a question, if they could just say who they are and where they're coming from. I know where you're coming
So
from.
I'm Martin
anyway,
Flick. I'm the chief executive of OneCom. We're a private equity-backed organisation. I've been around private equity for a while, always on the receiving end of investment. I haven't messed one up yet, and always had a good relationship with investors, and have worked extensively with Anthony in the past on a number of projects for which I can really endorse his expertise in this area.
Okay, that's it, guys. We need to say no more. Okay, that's it.
Go home.
I'll get you your money.
Just a glass of wine later will be fine.
Okay. Johannes, would you like to pick up on that?
So look, I think John said it well. It's when I think back maybe 15 years or so ago, we looked at what was happening in terms of digital as a separate sort of investing area. Today, we look at that in every investment that we're doing. And that's basically what's happened in terms of ESG. It really, whenever we look at a transaction, we're going to look at what are they selling? Does it have ESG impacts? And we have to do it because it's going to be relevant when we sell the business. Because somebody may say, well, this isn't appropriate what they're doing, and therefore you get a deduction in terms of value. So it's really become a sort of integrated part of our due diligence. It's very important in terms of what we're doing. Our investors care deeply about it. In terms of the EU has a numbering scheme as to how transparent and compliant you are with various ESG requirements. Our funds comply with some of the highest standards there, and so I think that's gone from, is it relevant to something that's really part of our everyday business, and I truly think that's a case with most of the industry. I don't really think there is a big difference between in terms of size as to how people would be looking at this.
Yeah, I suppose that one of the things I noticed in that, and I'm most probably speaking a little bit more from a public market perspective, is the degree to which you move from a risk mitigation process to a return enhancement. And that, I think, has evolved, and we are into that return enhancement because there is a differentiation in cost of capital. There's a differentiation in the opportunity set and people that are willing to buy and some of the parameters. But there's also, not to forget, that we all work in a policy-driven environment as well, and that many times that the reality is that even though we have some step backs or step side, the policy framework is still very firmly pointing towards a direction where we have to be thinking about how this is just a natural part of the investment universe, and the outcomes again that will be produced are so vital, given that future policy is likely to have more direction and more influence onto elements that ultimately are linked to forms of sustainability. Climate has obviously we've seen a slowing, but it's not. It's a trend which goes through certain oscillations, but it's still an upward one. And that, I think, is something that as a business, if you ignore, is very dangerous, because you end up in potentially you have tail risks that you've really not thought about until the moment that they all of a sudden become very real.
Yeah, please. Kevin.
Got an observation actually to your point. So we're Kevin Dunkley.
Sorry, can we get you the mic, Kevin?
I'm normally quite loud, Anthony, but so it's more in response to an observation in response to your point. So Kevin Dunkley, I'm Chief Sustainability Officer of HH Global. We're a Blackstone minority investment business. I thought it was interesting. When we were looking for investment, it was 2019, so pre-COVID. Part of the executive board at that time, we had 3 firm private equity offers on the table. I remember those presentations really vividly. One Monday, one Tuesday, one Wednesday. The term ESG, this is 2019, so probably August, September 2019, wasn't uttered once by any of those 3 organisations, one of which was Blackstone. not once. And I've even revisited those investor decks recently. And we talked about sustainability. We talked about digital a lot. We actually stood up some examples of the move from physical marketing to digital, and that seemed to catch a lot of attention. Then we had the pandemic, and we've been working with Blackstone for 4+ years. Deloitte, other organisations. ESG seemed to appear as a term around 2021, and we've now had lots of work on what that does to valuations. We're pretty advanced in sustainability, I prefer to call it. I think ESG tends to be what the investment community calls it. And some people in my role think of that more as a risk-based lens rather than are we changing things? Are we actually delivering longer-term outcomes? But I just thought it was interesting. 2019, in our world, maybe we're different. ESG wasn't mentioned. Now, we're seen as if you're in the top quartile from a Refinitiv or Sustainalytics, you know, 1.2, 1.5, 1.8 on the valuation. So in 5 years, I don't know if we're unusual, it's gone from not being mentioned to being, I'm being wheeled out all over the place. So I just thought that is a semi-answer to your question, what we're seeing. It's top of the priority now. 5 years ago wasn't mentioned at all.
Thank you. Deb's up over there.
The question of getting non-institutional money into private equity in bigger amounts than it is at the moment. I'm talking about England here rather than America, where obviously, you know, it's bluntly more developed. Do you really think that we're going to get more money coming into this sector without more transparency? When you get a guy like Malcolm Walker, who's not an idiot and has made a lot of money, making comments like that in the press, that the lack of transparency in the sector, and there is a lack of transparency to the average person in the street, they don't know what's going on, they don't understand, with all respect to KKR, who created, I think, the 2 and 20 structure, which is a fabulous structure if you're in the part of the 2 and 20, but not necessarily easy to understand if you're just a normal investor. Why should the guys who put the deals together, and as you rightly said, some of it over the last 40 years has been, you know, falling interest rates have made people an enormous amount of money, et cetera, et cetera, et cetera. So why should the 2 and 20 structure, the tax structure that's attached to that, why should that not be explained better to people? Because at the moment we're in a situation where no one really understands what's going on. They know that people in private equity can make spectacular amounts of money. They're not Dysons, they're not creating businesses like that. The record of private equity businesses that have floated in the UK stock market over the last 5 or 10 years, and you can talk about Dr. Martens, you can talk about Debenhams, you can talk about Saga, the list goes on, has been appalling. And so, without transparency, do you really genuinely think in a country like this, with the regulation we have and the potential for a Labour Party to come in power very soon, do you really think we'll get bigger amounts of money in this sector?
So I think the structure is not set in stone, and the structure will have to be adapted. The product it's not the same product that you're going to sell to an institution that you're going to sell to an individual, and so there will be a different product that's going to be constructed. That's for sure. It's a product that's too complicated to explain to somebody anyway. I think it's probably too complicated for the people that have to sell it to explain it, let alone the people that have to buy it. So it has to be a different, more simplified product with more transparency, with more liquidity. That's the answer to that. But that's what's happening. That's what people are creating, and I think that then will enable that demand to come.
Can I come?
Yeah, please
come in. I think you make really important points there. I mean, I think we may be on the cusp of a golden age of private equity in terms of the amount of capital coming into the sector, and I certainly agree with Johannes earlier. I mean, I do think that part of its success is explained by the fact it is a superior governance model for managing businesses in the same way that family-owned businesses tend to perform well as well. But I do think that it may, and bad news for the 500 people taking the private equity course, it may not be a golden age for people in the private equity industry in the way that it was for Johannes's generation. Because I think we have a really important, a really serious crisis actually in the long-term pensions industry in the West generally, and not just in Britain, but particularly in Britain, where the generation that had the occupational pension schemes is now retired or on the cusp of retirement. Their schemes are fully funded and are now in rundown. The generation of which I'm one of the earlier members, who are entirely direct contribution, don't have adequate pension pots. No one, the average size of a pension pot is £30,000, and they are mostly reliant on the public markets for their investment returns. And as you say, the public markets have come to be seen as, and are actually being used as, a dumping ground for the assets that the private equity industry can't sell to themselves or to trade buyers. And it's a real problem. The quality of the public markets has deteriorated dramatically. There are now something like 50% less stocks listed in London than there were in 1980 or something, 1990. So a huge reduction in the number of stocks. Try and get exposure to a tech stock if you're a UK investor with a direct contribution pension fund. You can't. You've got ropey international resources stocks listed in London, but nothing, no growth. And so it's a real issue. And so I think that it's no wonder that there's a move both from regulators, from government, to try and democratise the industry. But with democratisation will come transparency. It has to come, but also will have to come lower fees and greater access. So I think that the expansion of the industry. I think the path is now set in train. That this is a superior way of, or seen as a superior way of running businesses. It's certainly superior for the people who, as we were discussing earlier, for chief executives. It's superior for the investors. But it has to become accessible for the vast, from a public policy point of view, for the vast majority of the population who are going to rely on the long-term savings industry. And so that, I think, is a big policy challenge and will require big changes to the industry going forward.
I think just a final point on that one is it's probably also worth just stressing that not all private equity firms are successful with their investments. And if you look at the dispersion levels for private equity firms, in other words, the difference between the highest performing and the lowest performing, it's very big. So any investor has got to choose the right private equity firm that has a strategy that is going for the businesses that they're particularly interested in, and therefore they may or may not be successful. But all we hear about, of course, is the ones that are very successful. And if you did go back in time, and Johannes gave us a little bit of a quick sort of summary of the sector, you'll see some very, very substantial firms that particularly disappeared around the dot-com sort of point, where they had invested into a lot of technology businesses and never came out of them. Big names, particularly out of the US. Anyway, sorry, on to the next question. Yeah.
Hi, I'm Manu. I'm an undergrad at the King's Business School. So my question is on something that the panel hasn't really touched on, which is AI. So after ESG, AI is the most discussed thing today. And I really want to ask you how your exit strategies or your risk management strategies have changed with AI making technology redundant in every 2 years or so. And with the laws of physics, when technology is actually increasing its pace or doubling its pace in every 8 years, how has your exit strategy changed or your risk management strategy changed when you're actually investing in these companies?
I think it's one more for you to start. It's so tough, isn't it?
There's a fight for who gets that question.
But, I mean, I have a go. It's a so there's a part of the how do we incorporate it and how do you use it, and that and in reality, from an investor point of view, there's a great deal that's gone into efficiency of elements and an ability to analyse more effectively. I think looking at the private markets, it's that degree to which you can understand and look into and draw upon data and comparison and understanding, not just in a quicker speed, but actually the ability to look at much greater, richer data set than was possible. in terms of individual companies, I am going to pass that to Johannes to talk to in a second of how I think, as he was saying, that digital is part of every company and what it's achieving there. We don't invest directly into individual private equity or private companies. We allocate to managers that invest into it. But one of the things we look in there is the degree to which they are utilising, not just AI and generative AI now, but have been historically using forms of machine learning and also in predictive AI. Of what that would mean in scenario planning and thinking about what it means for the company and again the way in which the business can evolve, the way in which you'd be allocating capital in different parts of the business and in the portfolio. And I think those elements and seeing how that's being utilised as being very value and quite differentiating in terms of value creation. But again, that you need individuals who understand businesses and can help to change the operating model, the way in which they can be successful in their marketplace and in the strategy that they're running, which isn't necessarily driven by an AI component. It may have a digitization component within that company, which is important to understand what is it driving. But they're different to thinking of it in a now a generative AI, where, if I'm honest, it's more about how a company is going to be able to create value from this. Because one of the things that, if I'm honest, as sitting in the investor seat looking at the broader market, public and private, is there's a huge amount of capital going there that I've struggled to see the return on that capital in the time horizon it's being invested for. So differentiation, and back to dispersion, is actually going to be a really big issue as you look at how businesses either create value or actually are destroying returns.
Okay. Any other questions? Sorry.
Hi, good evening. My name is Nikita Khemani, and I'm a postgraduate student at King's. My question is that emerging markets, such as countries in Africa, face a lot of challenges which many advanced economies may not face. So when investing in such countries, what are the various risks and challenges one must consider?
Everyone's fighting with this particular question. Johannes, will you have a go?
So we have we're very active in Asia, in India and China. We have offices. We have offices in Malaysia, etc. We had an office in Lagos, and we closed it. Really because we've, at least from a KKR perspective, we couldn't find investments that were of sufficient scale. And if you look at the total volume that's been invested in private equity in Africa, I think it's under 10 billion for the whole continent per year. And I think there are periods where it's less than half of that. So it's not a very large industry, and there are significant other risks, in particular risk related to the Foreign Corrupt Practices Act and so on. That when you weigh up those risks against the small amount of capital you invest, that none really of the major firms have made significant investments in the country. It's more smaller specialist firms that are still active there at this point in time.
Yeah, and just that from what we've seen is that, again, because you haven't had a lot of that managed private capital, it's been much more direct private capital from related family businesses, allocated capital, and businesses to businesses that has occurred there. Because one of the part, and Johannes touched on this, is regulation. That the challenge for us is the degree to which our regulatory environment and some of the elements of lacking in regulation, comes back to governance again as well, are not at times at levels that we can actually feel comfortable and justify that engagement.
Hi, Crawford Spence. I'm on faculty here in the business school. Sometimes Britain feels like a developing country as well. In particular, I'm thinking about infrastructure, which is obviously has been highlighted as a key target for private equity investment. Whether it's water pipes, sewage pipes, electricity generation, railways, Some of our basic infrastructure in this country is really in a parlous state. Yet private equity has significant investments in some, if not all, of these industries. So where's the tangible evidence that private equity is helping improve things like infrastructure?
Well, all of these industries are highly regulated by separate regulators. And I think if you have a government that wants to keep bills flat or decreasing, which is what they have in most of these industries for the last 20 years, and at the same time wants to have the infrastructure improved, then that's very difficult to do by really any investor. So I think it's really a government policy and what are the priorities. And if the priorities are to improve the infrastructure, and you want to have investors that are that will make a halfway reasonable return, not outstanding returns, then you need to think about bills that are increasing. And that has so far not been on the agenda of the government. And so I think unless that conundrum gets resolved, it's going to be a tough task.
Paul Guest, Professor of Corporate Finance at the Business School. A question for Johannes. You mentioned earlier the value drivers in the earlier periods, but not for the most recent time period with the low interest rates. I think for the academics in the room, we'd be very interested to hear your opinion on that.
Yeah, look, I mean, the industry has benefited significantly from lower rates, right? Or from decreasing rates, because if interest rates are lower, multiples are higher, and so during that period, a good part of the return has been generated by multiple expansion. That's over. But when you take the returns apart, and the industry associations have done that, not all of the return has come from multiple expansion. Still, a significant part has come from effectively margin improvements or operational improvement. And I think that's why going forward, from a return expectation, generally people are expectations that returns will come down, and the reason is that you won't have the multiple expansion part of the equation. What it means is that we're going to pay less for assets going forward, because whereas before you could say, well, I can create part of my return from multiple expansion, now you have to assume that there is either multiple contraction or the multiples are going to stay stable, and that means that you can pay less and to generate the same sort of level of return. And I think that explains why we've seen a slowdown in the private equity markets. Last year were down 40% on the previous year. So there's been a significant slowdown in volume. And the reason that we've seen the slowdown in volume is that there has been that sort of disparity between supply and demand. In other words, people aren't willing to sell assets at lower prices, but the industry can only pay lower prices if they want to keep on generating decent returns. And that's meant there's been a significant reduction in transaction volume.
I think we take one last question. I'm just trying to get us back on track. Sorry, yeah.
Thank you so much, guys, for taking the time. Really appreciate that. My name is Eid. I'm an undergraduate student here at King's. And I would really like to ask you, especially within the private equity sector, looking really at the real estate in different location and geographic areas, such as like Ukraine and Palestine, and what's really happening those days. There's a lot of a dry powder, almost with every private equity firm could really see. And I just really wanted to see, do you really think like there is, in the right time, like today, it's a good opportunity to invest in those places? Or do you think the clients, they might really have any concern that what might really come like soon, or is the situation might end up very soon or not? Like, what's your really thought and perspective on that?
When we look at infrastructure investments, we're trying to make those investments lower risk than private equity investments. And the reasons are that we're investing in businesses that are more stable in theory and more predictable. And so you don't want to take additional political risk. So I think it's unlikely that you see infrastructure funds invest in areas where there's high political risk.
Yeah, I think there's a part as well that's really important, is that when you think about what will happen to be able to regenerate, that a lot of this is going to be the restructuring of existing debt and to create new capital to be able to go in. And that really is, in some ways, is a sovereign and a public markets environment. And that part has to heal first before you then can have private capital flowing in to be able to consider and see that there's the opportunity. And as Johannes said, I think that for all of us, the challenge is that there's a great deal of focus on these areas and trying to think about the future, but obviously it's not something that can realistically be on an investor's desk today.
Okay. I'm sorry, I think we're going to just on timing probably just move on to the next phase. So thank you guys for your contributions there, and thank you. So we're going to just vacate this area and just move over there for a second or two, and Robin will give you some extra comments on the back of that.
So thank you very much, Anthony, for spearheading, for leading this event, which is a terrific example of what we do here at KBS and what our fantastic executive fellows, Anthony, Kevin, for example, bring in this connectivity from KBS out and from the industry in. I'm standing between you and the refreshments and food in the back, so I'm aware of that. So I'm going to keep my thoughts brief. At the outset, Anthony said that there were 4 things that he was going to cover, so I've organized 3 themes, 3 thoughts to think about. And to just, Joanne, to your point about the sort of for my sins, just to say that I spent 10 years in the hedge fund industry, which no one likes, right? And making the case for social value from the hedge fund industry is even a tougher thing. So I've now, as an academic, I study venture capital, which everyone loves, right? So this is sort of a theme, this transformation or change in the depicting of things. Also worth mentioning that if we are headed towards a challenging era, I was told when I started working on Wall Street that you don't learn anything in the good times. So if you are one of the 500 in Anthony's private equity class, in the tough times is when you learn the real stuff. Okay. So 3 themes that have struck me. So first, this golden era and what is this social value of private equity, which again, easier case to make here than, of course, the hedge fund world, also in so many ways. So 1, economic growth and job creation as levers, as clear contributors. In the discussion, there was talk about stimulating economic growth through different levers, thinking about the earlier stage in funding innovative startups, thinking about driving scale, right? Building businesses of tomorrow. And also boosting the performance of struggling firms through that G, through the G and the ESG. Also, what didn't come up as much as perhaps I would have expected is the potential for job creation, and through that G, the training programs, and perhaps also the sort of skill enhancement, right? And the societal value that this brings, the upskilling within portfolio companies. So for me, this is one key theme, the economic growth and job creation, which in the run-up to the election is a nice sort of theme or header in particular for private equity, perhaps. Second, which Anthony started with and then came across different questions and across the panel as well, is sustainability or ESG, right? So the rise of ESG commitments. What's the role of private equity? For me, the conversation sort of thrusts is around mainstreaming sustainability or ESG, choose your language, right? Mainstreaming through data collection, right? Having to build systems to collect the data, to measure the impact, right? By standardizing due diligence around ESG, right? So also a theme around the phrase, in particular, private equity to fund the transition, right? What is the role of private equity here in ESG? Thinking about the sort of non-financial ROI aims, the social KPIs, if you will, right? How to the comments about the 2 and 20 model, right, which exists across the private markets, of course, right? There's tales, right, of course, of private equity firms having effectively a self-imposed hurdle rate, or saying that they're not able to unlock the 2 and 20 unless certain social KPIs are achieved, right? So ESG sustainability is one of these themes in the value of private equity in this golden era. Third, innovation and long-term value. And this was something that certainly stands out, but also thinking about across the life cycle of businesses, especially early stage, in questions that came up towards the end with AI, for instance. The role of private equity in fostering innovation. Right? Innovation and technological advance is not neutral, it has a direction. Policy, regulation, government plays a role in that, but who's funding, who holds the purse strings, is materially important. So the role of private equity in what it's funding in terms of fostering cutting edge technologies, be it digital, be it AI, be it around the net zero transition. Modernizing infrastructure came up, I think, maybe more than I had anticipated. But the infrastructure taking different sort of forms, right? Physical infrastructure, but also, I think, one of the themes being digital infrastructure as well. What's the private equity focus here, given that long time horizon? And as someone that worked in the hedge fund world, where you're looking at some strategies that are trading in and out in a matter of seconds, the long time horizon of private equity is a fundamental different thing, which has a different alignment or impact in terms of this long-term planning, these priorities that can and perhaps will align with the next government, perhaps. And I just wanted to close in sort of this bookend in thinking about, you know, the history as Johannes started with, and if I may, thinking about the sort of perception of private equity and how far we've come in different ways, right? The sort of the barbarians at the gate, if you will, and the leverage buyout era. But there's a Wall Street Journal to the role of journalists. A Wall Street Journal article in the throes of coming out of the global financial crisis that has always stuck with me. So Chris Mims, a technology columnist, I think at different points, maybe editor for the Wall Street Journal, titled a piece, Venture Capital, Humanity's Last Great Hope. Right? So imagine that arc, right, and that hopefulness. I will close on that hopeful note and say thank you again, Anthony. Thank you very much for our distinguished panel, and thank you to our fabulous community within KBS and our wider community in the industry and beyond. There are refreshments in the back. So if you exit either door and you turn in this direction, you will be rewarded with further conversations and with refreshments. So thank you very much.